Hello, everyone, and welcome. Thank you for joining us for today's program titled Life After de-SPACing, Key SPAC IPO Considerations for Private Companies. Before we get started on today's presentation, I would like to go over a few housekeeping items. If you have questions about any of today's topics, we invite you to type them into the Q&A widget on the left side of your screen. Questions will be answered throughout the program. If you experience any technical difficulties with the webinar platform, please refresh your browser or see the webcast help guide on the bottom of your screen, which is designated with a question mark icon. As a final note, there is a short survey located on the right side of your screen. We would greatly appreciate your feedback on today's webinar. And now I will turn it over to Paul Broude to begin today's program.
Good afternoon. Thanks to everybody for joining us today. I know we've got a big group, and our goal, despite the virtual presentation, is to have a conversation as best we can, certainly among the four presenters, but also taking questions from the audience. And don't hesitate. We'll try to leave some time at the end, but if you send in a question and it seems to be something we can answer as we're going along, we will try to do that as well. As I said, my name's Paul Broude. I'm a partner in Foley's Boston office. I'm a member of our transactions practice group and capital markets group. And along with my fellow presenters, John Lipman from Craig-Hallum, Chris Hodges from Alpha IR, and Scott McGurl from Grant Thornton, have spent a good part of the last 18 to 24 months working on SPAC and de-SPAC transactions. So our goal here today is to help companies think about the things they have to prepare for life after the de-SPAC transaction. And I think we'd like to get started just by asking each of John, Chris, and Scott to briefly introduce themselves and their background, and then we can move into the content of today's discussion. John?
Great. Thank you for the intro, and thank you for the opportunity, and thanks for joining for all the participants. John Lipman, I'm a partner in investment banking at Craig-Hallum Capital Group. We're a 26-year-old growth stock investment bank headquartered out of Minneapolis with a few offices across the country. I'm in our Greenwich, Connecticut office. I'm also the head of our SPAC investment banking practice and have been focused in SPAC since around 2008 on and off, and also lead a couple other sectors of investment banking at the firm.
I can go next.
Chris?
Chris Hodges. Hey, thanks for everybody for joining us. Looks like we got a couple hundred people, so this is exciting. But Chris Hodges, I am the CEO and founder of the Alpha IR Group. I've been an IR consultant for about 22 years, working with all different kinds of companies in different industries. Alpha IR is about 30 people. We've got offices in Chicago, Boston, New York. Pretty in the weeds on the IR side and really helping our clients build their investment brands.
And I'm Scott McGurl. Thanks, Paul and team, for having me on today, giving me the opportunity. I'm a partner with Grant Thornton Strategy and Transactions Practice based here in Minneapolis. We are a global professional services firm, audit, accounting, advisory, consulting. Been working in the corporate development space in both an industry and consulting for way too long. Worked with many companies from pre-revenue and startup phases to Fortune 100 companies that are looking at carve-outs and creating new entities. So the SPAC boom has been phenomenal over the course of the past 18 months. It's become very embedded in the fabric of it, and I believe it's an investment vehicle that is here to stay.
Thanks, everyone. So as I mentioned, the goal today is really to focus on life after a de-SPAC transaction, and in particular, some of the things that companies may not expect or think about, and the things they have to be prepared for to avoid problems after they become a public company. But given the increased focus on SPACs over the last 12 or 18 months, particularly the recent SEC scrutiny of some of the SPAC elements and disclosure issues, we thought it made sense to start with sort of a quick discussion on the pros and cons of the de-SPAC version of going public versus a traditional IPO, and where the group thinks the SPAC market is headed, because some of those things play a fair amount into some of the things we want to talk about later about life as a public company after the de-SPAC transaction. John, do you want to kick off that discussion for us and give us a little bit on a perspective on kind of compare and contrast and where things are headed?
Yeah, absolutely. So, by the way, just in my background as well, I've also been a sponsor of SPACs over the past 18 months. I'm the co-CEO of Roth CH Acquisition 3 and board member. I'm a board member and COO of Roth CH Acquisition 1 and 2. And we do have a fourth one coming out shortly. And so a unique role here is not just being a banker, but also a sponsor myself and having been involved in these transactions for a while. You know, the product really was invented in the early 90s as an alternative to an IPO. And the first series of SPACs that had been taken public was created by a banker and a lawyer. And, you know, there's argument who actually invented the product. But the idea was an alternative to an IPO, an entrepreneur, captain of industry, maybe a technology entrepreneur, raised a blind pool of capital. And the idea was, hey, you know, this person has unique expertise maybe in software or some type of technology business. They have tons of relationships with privately held businesses. Very quickly, just by executing a merger and a reverse merger transaction, can take a privately held company public, give that privately held company the capital, the institutional shareholders and retail investors from the SPAC, and also that sponsor was also sponsoring this business and going to help foster that business as it, you know, goes through the first series of years of growth as a public company. And, you know, that the product's been around for, you know, quite some time now, and it's evolved. And so the most recent, you know, series of SPACs, you know, this product has evolved into, you know, it's still a quick alternative to an IPO. You know, I'd say the few, you know, really juicy points are, you know, once a SPAC has gone public, it's very quickly to take a SPAC public. You create an LLC, you put together a board, you put together a team. You've got an idea of where your deal flow is going to come from. Maybe it's a bunch of different private equity executives or people from different types of, you know, corporate experience. They can raise an IPO within 60 to 75 days. There's a bunch of money sitting in a trust account. The entrepreneurs cannot touch this money. This money is actually for an acquisition. The investors that give the SPAC the capital, the SPAC sponsors have to put up some capital as well, called risk capital. But the investors that put up this capital have the right, whether if they like the deal, to stay in the deal and vote yes in favor of the deal and keep their money in the deal, or they have the right to vote no and get their money back, or vote yes and get their money back, depending on what the transaction is. At that time, which is the de-SPAC, and you're now the merger is consummated, that's when the capital is released from a trust account and that privately held company gets that capital. This process, depending on how quickly that the entrepreneur can find a audit-ready, public-ready company, could be months, could be a quarter, could be 3, could be 6, could be 9 months quicker than an IPO, depending on, you know, the situation. So today, SPAC sponsors are looking for companies that have 2 years of, you know, rule of thumb, 2 years of PCAOB audited financial statements. Scott can talk to you about that a little bit later and what that means. They've got a management team, they've got a board, they've got a CFO, and so very quickly, that company, a private company, let's just say, you know, wanted to do an IPO, it's got to go find an investment bank, it's got to go write a prospectus and fill out a summary about who they are and what they do, and get presentations and get the board and get all these things put together. They'll hire investment banks like us at Craig-Hallum, or it could be a Goldman Sachs or whoever. And that investment bank's going to have to do its diligence on the business for 30, 60, 90 days to get comfortable, to the point where with the auditors, with the lawyers, with the consultants, with everyone and the bankers, they'll put together this prospectus and file that with the SEC and do an IPO. Then you're subject to the SEC, you know, review process and however long that IPO will take. And so for an entrepreneur that runs a software company or a tech company, or what you're seeing, maybe some of these electric vehicle businesses or a healthcare business, a lot of them just want to grow their business. They want to focus on what they do really well, is making diagnostic products or building, new types of vehicles. They don't want to be focused on writing documentation and audits and filling out forms with the SEC and working with lawyers for a 6 or 9 month process. And so, what we found historically is an IPO. Some can be a little bit quicker. Or rule of thumb takes 6 to 12 months to do an IPO. And during that time, the entrepreneur or CEO is really focused on that part of the business and lose a little bit of sight, the CFO, CEO, from the business. And so the unique, positive part about this, and one other thing, when the IPO is ready and the SEC clears the process to do your IPO, you now have to look at the market and say, gee, the Dow is at 35,000, or, the market just tanked and all of our comps are down, and the market, it's a different market dynamic than it was 6 months ago. Either you're going to get your IPO done at a price your banker thought was realistic, or now the price is going to be lower, or it could be higher, or maybe you have to wait for a while. So the unique thing about a SPAC and why it will be around for, probably another 20 years is in a very short period of time, could be 30, 60, 90, 120 days from an entrepreneur that has a SPAC and has the capital and has the resources to diligence a business. And if that private company already has those 2 years of audits, you can quickly give that private target company a few things that they cannot get in an IPO. You could give a guaranteed valuation today. We're going to buy your business, let's say, for $1 billion. You're going to get 100 million shares of our stock at 10, or we're going to pay $750 million in stock and assume $250 million of your debt. At close of merger, that's what you're receiving. You'll get our 100 million or 200 million in trust. From the diligence process, you will still have to do a presentation. There will still be a proxy that will get filed that is similar to your prospectus. And coupled to today, what we've seen in the past 24 months, and we really started seeing it about 5 years ago, is a PIPE investment, a private placement of common stock, could be convertible securities or debt, that is supplementing this merger transaction. At the time of close of merger, that capital comes into the business, which gives you a guarantee of a certain amount of capital, because I told you investors can vote yes or no if they want their money back. This private placement is a guarantee that you're going to get that money as a private company. So the long-winded, but you're a privately held business. You got $1 billion offer on the table. You have to spend 60 to 90 days on diligence. Lawyers are going to work on documentation. You might spend a few weeks working on a private placement. But by the way, at 3 months, let's just say it's 3 months, you can announce that you signed a merger agreement. It's a definitive merger. You'll file your proxy with the SEC. You'll announce that you signed a PIPE financing. You've seen a lot of these SPACs announce $100 million to $1 billion SPAC financings, and you have now locked in a valuation. You've locked in capital from the PIPE, and you now have a closing process, which is similar to the IPO process, which you filed the proxies and you go through the SEC review process and it closes. We've seen SPACs from start to finish close a merger within 6 months, 7 months, but that entrepreneur is shaving months, and months could be millions. It could be, and I'll just use the last example. Ken Moelis took his company, Moelis & Company, public. I saw him on Bloomberg, and he was saying something about SPACs and why he thinks SPACs will be around forever, and I think it was really intelligent. He said, I did my IPO. It took me a year to do my IPO, and I'm the number one banker at the firm, and I really focused on the IPO than doing my business, right? And I did not know if my IPO was going to happen until 48 hours before we priced the IPO. If you can give me if you can give me capital and an IPO coupled with, a PIPE and in a SPAC merger and shave 6 months of time off that for me, that's a product that's going to stick around, today. And so what this whole seminar we're talking about is, SPAC process is a little quicker. There's a lot of different, nuances to it. and you're going to need to couple it with, a really great team of advisors. IPOs are a little bit different, and prepare yourself because you're not going to have the 12 months. You might have just the 3 to 6 months to get yourself ready to being a public company.
Yeah, John, thanks. I think you kind of hit on the key point. In practice, my experience has been that completing the de-SPAC transaction often isn't much shorter by the time you get through the SEC review process, particularly in the current environment, but you do have the certainty of valuation. But the fact that it does tend to be a little bit shorter, and that's the aspiration that everybody has, means that companies really need to be well prepared to be a public company prior to undergoing that process. Because as you describe the IPO process, it's typically a year-long or 18-month-long preparation to get to the point of being ready to be a public company. Somebody recently described, de-SPAC targets to me, and this is a former partner in another big accounting firm, as somewhere between unprepared and woefully unprepared. And that's a lot to overcome in a relatively short period of time. So I think it would be useful for folks and maybe Scott can kick this off, to talk about what people see in the companies that are more successful at making the transition through a de-SPAC process to be a public company, and which ones may struggle a little bit, and what are some of the things that people who are considering a de-SPAC transaction can think about from a planning perspective as a result.
Mm-hmm. Yeah, Paul, absolutely. I'll start with a little bit of background on the numbers. I mean, as we've been tracking SPACs over the past 20 years, there's over 1,000 SPACs that have been listed. This year, 21 to date, as of today, there's 381 SPACs that have IPO'd year to date. In total, there's 423 that are still out there looking for target companies. And there are thousands of private companies that are competing with the funds that are available to get into public markets through those SPAC vehicles. So with that, they come in all shapes and sizes. What we've seen is that there's, a complete spectrum of preparation. You nailed it. It's how do companies prepare themselves for public markets, because it is a very different game. And just give you some anecdotal stories of two clients that I'm working with pretty closely right now. One is very successful. They had their emerging growth company. When they completed their merger in January of 21, their stock has continued to ascend, and they're sitting at over 250% their initial value at launch. They were on a pathway about 18 months before the SPAC transaction to do an IPO. They had a public company experience management team. They had the right governance and board structures in place for their audit committee, compensation committee. They had internal controls designed. Their emerging growth company, which provides some additional assistance, but they actually had internal controls over their financial reporting already in place. Strong FP&A capabilities, good IT infrastructure. And so they've done a phenomenal job. The reason why they decided to go for a SPAC versus an IPO was timing. All of a sudden they looked at the market and saw a tremendous number of SPACs that were coming after them. And they saw an opportunity to increase the valuation from what they had planned, accelerate the pathway, but they were already ready to go. And so it's been a good story. Now it's working with them to continue to commercialize and scale their offering. On the other hand, I have another client that's been around for years and operated in the private markets in a very entrepreneurial way, decentralized management structure, decentralized government, zero public company experience, internal controls designed, but no real pathway to get there, virtually no FP&A capability. And they completed a transaction in 2019. They're over $1 billion, so they're not. They don't have the extra 5 years leeway of an emerging growth company in EGC, and so they are now really under the gun to be able to get themselves straightened out, to be able to provide quarterly guidance to the street. The first year that they had their post IPO or should say post-merger audit done, there were 7 material weaknesses. And so now it's a struggle for them to be able to catch up very quickly and be able to provide the right guidance to the street and operate like a public company. And their stock is taking a beating for it.
If I could build on that maybe a little bit too, I see this on the IR side too. I think about half our team here has been on the advising side. The other half are ex-Wall Street guys who've invested directly in SPACs and IPOs. And one of the things we collectively talk about, and I think Scott was hitting on this too, is that we've got to help our clients avoid that burnout factor. This is a really time-intensive process. Being a public company is a commitment, right? You're going to lose a few days every quarter to managing investors and managing your Wall Street audience and taking that time ultimately away from the business that you used to be able to put in the business, right? You go through this rush to get public, right? Announcement day and analyst day, and then you have a grueling set of one-on-one meetings, back to back, saying the same thing over and over again. There might be a 25-year-old investor who openly questions, the way you run your business that you've been highly successful at doing over the last 30 years, which, can be really disarming, to a successful CEO who maybe built that business from scratch. And so where we see success and failure in the aftermarket and the after SPAC process is, do CEOs and CFOs know how to manage that burnout issue? Some of them often retreat back and kind of hope, hey, I put up good numbers, that's going to drive my stock price. They don't message appropriately. They don't think proactively about how they have to educate and re-educate shareholders. They don't stay visible enough because they've got a shareholder base that they need to transition into much longer term shareholders over time, versus others, really understand that they've got to put their best foot forward. They've got to look at every single time they have an earnings call or a conference that this is a chance to re-educate and really guide the street and control my message and compete for capital effectively. And so I think that what really for us defines success or failure sometimes in the aftermarket here is, do they really take the right approach and stay proactive with their IR program and avoid that burnout factor too?
I just wanted to add one thing, Paul, or 2 little points, because I saw some in the chat box. Some of the negatives. So there's the positives about the speed, right? And I talked about that. But the negative is there are businesses that are just ill prepared, right? And they're not ready. And as Chris and Scott, and Paul, you can attest to, the management is excited and attracted to the dollar signs, right? And getting money for their business, but really has never run a public company before. So doesn't know about quarterly calls and updates and doesn't understand that, if we told people we're going to do 25 million in the fourth quarter and we end up coming in at 15, our stock's going to really, collapse. And so, being, not just presentable, but being able to deliver on a consistent basis growth, is very important. And especially for smaller or fast growing companies that are earlier in the cycle, performance can be lumpy, right? So the other negative is, it's a greed product, right? So the people that create the SPACs have a certain economic incentive to get a deal done. They have a big carry. It's 20% economics in the size of the SPAC. Now, they have money they put up for the SPAC, but they have a big, lump sum gain, in equity if they can get a merger to happen. So you see we have seen, people acquire businesses. The SEC just recently cracked down. A company, very quickly went public, and the sponsor of the SPAC didn't do quality diligence. They said that they did, but the SEC has made charges that there's, some disclosure issues on who the management is. Their business does not have the performance that it said it did. And again, anything that you do in life that you can do super quick and cut some corners, there are going to be people that cut a lot of corners and don't do the work. So speed is one thing, but cutting corners on diligence doesn't work. And so we've seen a lot of SPACs over the past 10 years go public. The businesses were not prepared. That one big customer they had either dropped or they didn't have the CFO and team to have controls on those financials, or there wasn't disclosure, there wasn't high quality diligence that was done. And, that business, that they gave lofty, right now there's a loophole where on an IPO, a prospectus, there's certain disclosures versus a merger agreement, which is a SPAC. So people have been able to give this forward-looking guidance without the liability, which the SEC is now cracking on. So people are saying in 2025, we're going to do $1 billion in sales. And so there's issues here and there's negatives, and it can be very dangerous. So we've got to, if we're going to do a quick deal, we got to have real arms around the business and understand that this thing is ready to go public. And if not, it could be a big problem. And that's the reason for this, seminar today.
Well, I think that's right. And I think some of the issues around the SEC scrutiny and some of the disclosure issues that some SPACs and de-SPAC companies transactions have run into have been fairly well publicized in the last couple of months. And the SEC is really focused on, as it always is, on disclosure, particularly of disclosure of conflicts with SPAC sponsors and adequate disclosure about the company. And I think that's true. The sponsor conflict issue is unique to the SPAC, but disclosure about the company's business and an accurate presentation of it is critical even in a traditional IPO. In a de-SPAC, you have the added factor of projections, which has become kind of a hot button. But in terms of planning going forward, I think Chris really touched on, and I think Scott did as well, on the need for planning for the post-transaction experience. Because just like a traditional IPO isn't the end, it's the beginning of a new part of the company's life, the same is true of a de-SPAC transaction. And from what I've seen in a number of these transactions, it's as important for advisors to work with the management team and the board of the company and to educate them about what comes after the de-SPAC process. It's such an intense transaction in terms of the various pieces that go into it that people sometimes don't take the time or feel they don't have the time to deal with life after the transaction is completed. And so what we often see is companies that have completed a de-SPAC transaction, have a 10Q that's due in a relatively short period of time, have an obligation to file a registration statement to register shares that were issued in the PIPE transaction or to the sponsor or even to the target company shareholders, and not a good game plan for how to do that. And I think it's critical, and Scott, maybe you can comment on this from the accounting perspective, and then Chris from the IR and investor relations perspective. What things management should be thinking about in terms of developing the right kind of timetables, systems, teams, responsibilities, and assignments for the public company reporting obligations and then the investor relations process so that they hit the ground with a plan on the day the SPAC transaction closes and aren't thinking about, for the next 60 days, what do we do next?
Yeah, Paul, a number of things. I mean, as John started out and mentioned PCAOB financial statements. And so I think even to be looked at, John, correct me if I'm wrong, from a SPAC standpoint, you need to have PCAOB, Public Company Accounting Oversight Board, compliant financial statements. You need at least 2 years of audited financials. If you're a non-EGC, typically you need 3. And so with that, I mean, that's kind of the baseline to be able to even get into the game. The next thing is looking at internal controls. Sarbanes-Oxley 404, you need to have internal controls that are designed for an EGC, and you have to have sign off on compliance from the ability to have those all in place and monitoring in place 2 years after or I should say two reporting cycles after your listing. If you're an EGC, there's a delay on that. You have an additional 5 years. But if you grow over $1 billion, you're no longer considered an EGC, and you need to be able to be 404 compliant at that point in time with the controls in place. And so those are two significant things that need to be there. The governance side of it, a lot of private companies have directors that may or may not have the requisite experience. There are guidelines of what committees you need to have by the SEC to be in place, and they need to be independent. They need to be experienced. Those things are I would say something that you from the clients that I work with, a lot of them are looking to the SPAC sponsor groups to be able to get the access to the right management team and the right boards that can come on board to help in those situations. And transparency, FP&A is not easy. Financial planning and analysis is it's not accounting and reporting. It's the ability to really bring together processes, behaviors, technology systems to be able to provide transparency and accurate guidance to your organization and to the street. Even mature organizations have a hard time being able to accomplish that. And then the timelines, just the overall level of effort that it takes to manage the timelines, the reporting requirements, and Chris, you can hit on this from an IR standpoint. It takes a lot of time and effort, and you need to plan for it accordingly.
Yeah, from an IR perspective.
If I can just jump in, Chris, just for one follow-up question for Scott before you talk about the IR function. Scott, we've seen tremendous difficulty in companies building out their internal finance teams, either during a de-SPAC process or to be prepared afterwards. It's a tough hiring market. What are you seeing there? And are you seeing, during the de-SPAC process, we see a lot of companies that end up with two big accounting firms, one of which is doing the audit, and the other is really providing the internal financial reporting support that ultimately a public company hopes to be able to have the in-house capability to do. Are you seeing recently de-SPAC companies continue to rely on outside service providers to do some of that work as well?
I will say, Paul, first and foremost, business is very good these days. Yes. And so the preparation for public and then the de-SPAC process and then ongoing, a lot of organizations, especially, and I wouldn't say especially emerging growth companies, because there are a lot of organizations that have done the proper preparation. But it's just that muscle memory around being a public organization, having that finance experience in-house. A lot of organizations do not have that. And so it is a recruiting, it is a retention, and often cases for us, it's a two-in-a-box situation where we're acting as an advisor to help build those capabilities from an internal audit standpoint, a controllership standpoint, a financial planning and analysis standpoint, and bringing those capabilities to life and then transitioning out over time. But yeah, absolutely. That is, without a question, the number one area that we see organizations struggle with because it is so important, and it's fundamentally different than how most public, or I should say most private companies are managed.
And then I'll just throw some bigger picture kind of IR thoughts around preparation. Think about IR in kind of four buckets, right? There's a tactical component to IR, and there is a lot of tactics that go into this function, whether it's, why is the information in Bloomberg wrong? Why is Bloomberg reporting my EBITDA differently than I do? Why is FactSet's consensus estimate different, maybe than First Call? And so there's a fair amount of tactics that go into it. There's a lot of benchmarking that gets into what kind of information do I need to give my board to make sure that they're educated and they know we're doing the right things and we have a plan on the IR side. And so there's a lot of benchmarking evaluation work. But the two most critical pieces are probably more in the messaging and the visibility side. Now, in the messaging, you're jumping into a time period where you're going to be asked uncomfortable questions. You're going to have to make decisions on what kind of information are we comfortable providing? What kind of information, from a competitive perspective, do we not want to provide? You're competing for capital against hundreds, if not thousands, of other options, in terms of the investors that you're talking to. And so you have to strike a really interesting balance between educating new investors and re-educating kind of current investors that have a different level of sophistication. So getting some real support, whether that's an internal IRO if you're big enough, or whether it's an external firm, make sure you're finding a firm, I think, that can help you, or a person internally that really have the experience to help you message effectively. It's critical in terms of really competing, the right way, and making sure, in particular, we're seeing a lot of people come off Wall Street and fall into these positions too. You really need to have people, I think, that have that experience at the end of the day. And then on the visibility side, as you think about kind of the two key constituencies, you've got analysts, right? Guys who write sell side is the term that you'll hear as you get into this. The guys who write research on you. At the end of the day, if you're in an industry that has a natural set of peers, attaining that coverage is going to be a lot easier. So if you have a number of public peers, I'll give you an example. An auto aftermarket client of ours has gone through this process, and they've already picked up a number of sell-side analysts because it's natural for them. They already know the space. They know the model. They can pick them up quickly. But if you're in a really unique industry, you're the only maker of widgets that's public in this specific niche, it's probably going to be a lot more difficult to pick up sell-side coverage. They have to learn a new industry. They have to learn your model, and it's really not very cost-effective for them ultimately to cover you. You're going to have to be a lot more proactive. And the same thing on the institutional investor side, right? Most companies are going to end up 95% institutional in terms of who their holders are going to be. You're going to inherit two really interesting and kind of eclectic shareholder groups through a SPAC process. First, your SPAC group that ultimately owns the SPAC side, generally hedge funds. They've hedged it multiple ways. They're probably not going to be a big priority. You can't ignore them. You're going to have to spend time there, but they're probably not going to be in you for a long period of time. But on that pipe side, as John talked about, that's where we can get some more quality investors. That's where your first focus is going to be. But you're still going to need to round that group out. It's going to take you 1 to 2 years to get the T Rows and the Fidelities and some of those longer-term holders, to pay attention to this. And again, it's a proactive process that you've got to be ready for. I think ultimately to get that shareholder base to be supportive of the valuation that you ultimately want to have.
So, one of the things that one of the areas, let me put it this way, where lawyers, investment bankers, and IR professionals are often in conflict, or sometimes in conflict, is what management should be saying to investors, whether it's at conferences, in press releases, in public statements, and interviews. Lawyers tend to be very cautious about Reg FD and making sure that information isn't being given to some investors and not to all investors, or not properly caveated. Bankers and IR professionals are often in a position where they're trying to help the company spread their story and create interest in the stock and the business as broadly as possible. Chris and John, how do you help educate your clients about how they have to approach dealing with the public markets, keeping in mind some of the the legal constraints and concerns about sharing only information with some people?
John, why don't you go first? I can
great and good question. I'd say first is once you've announced your SPAC merger, the most important thing is to file a proxy in order to get your shareholder vote to occur. That proxy is going to have it's bolstered information on the business. Until the proxy is filed, there's just an 8K and a PowerPoint presentation and your financials, but it doesn't have the whole history about how the SPAC met you and everything about the business and everything about the SPAC. And so we prefer to have that information on file before you start talking to investors. And I think this circles back to what we've been talking about is having a real business plan and having real projections that have been not we're going to do 100 million this year, but we really got to on a board consensus where we're going to hit revenues. These are the milestones. Acting as if you are a seasoned public company, those businesses are going to use their script, their PowerPoint presentation, their story they're going to use with investors. Their message is going to be a lot more detailed, and whether they give quarterly projections, annual projections, or no projections, their message is going to be a lot stronger because it's a well thought out plan versus someone that just wants to jump into the public markets and will say anything that they think sounds good. We need a concise message. We need milestones, as Chris is going to tell you, so that if you achieve and hit that milestone, an investor will say, okay, well, they're actually performing. I needed to see, and maybe there's a couple milestones, and then that investor starts investing in your company and becomes a shareholder. And I just want to say one other thing about these investors. You know, the investors that buy your IPO for a SPAC, let's say you did a healthcare SPAC. Some healthcare SPACs have only healthcare investors. There are some SPACs that just have some healthcare investors, and it might have SPAC investors that are specialists that buy SPACs. So it's so important that you have this detailed message put together the day that you do your de-SPAC and your roadshow and start your life as a public company or on your way to being a public company, because there might be investors that own your SPAC that really don't intend to be here long term. And so we need to be able to have all the markers and all the milestones in order to attract, whether Chris was saying that the T. Rose or Fidelity, what are they looking for you to achieve? What is success? They're looking for that long-term growth company. You know, let's have projections and milestones that are achievable. And some people have used pie in the sky, numbers that, if everything, every light is green, it will work out. But if not, they're going to be in the penalty box for a long time as a stock. So I throw it back over to you, Chris. But for us, serious diligence on your numbers. You've got to own if a partner says you need to own your numbers, you have to hit your numbers. You need to perform as a public company. It's not acceptable.
It's such an interesting topic. The word guidance outlook is what we're kind of hinting around. And it's an interesting topic because I'm sure all of us have had some fairly heated arguments with each other's counterparts around different guidance related issues through earnings cycles and et cetera. And again, when I think about what we do, I don't think about that we drive stock prices. I think that we help companies manage credibility, right? If we manage credibility, if we build transparency, the story will ultimately sell itself. And so guidance is a really big topic. And SPACs, to sell the deal correctly, ultimately are putting out some really specific numbers over a set of 5 years, direct targets in some capacity. And the thing I will say is I really believe in the concept of guidance. I've worked with companies that have 3 sell-side analysts and 1 is off the reservation. And if I didn't have a tool to help corral those estimates and make sure that we were managing that group effectively, it would probably be a problem. But when I go into a company who's guiding its whole income statement and they're putting out 10 metrics and they hit 7, but they miss 3 small ones, everyone focuses on those 3. So when I think about guidance, we like annual programs. We like to, especially for our lumpier businesses, because they're a little bit longer term, that you're able to manage that throughout the year qualitatively and give people different pieces of guidance. But as a SPAC, you're ultimately going to probably put out some very, very specific numbers. And having worked with public companies for 20 years, I can tell you that forecasting is not necessarily the greatest skill of every public company. So it's difficult. But the thing you're going to do through that first year or 2 is really manage, that initial guidance that you've given. And so we're going to be held accountable to it. You're going to have to be really thoughtful about how you manage things that change along the way. You've done an M&A deal. Maybe you've had some different innovation that maybe changes kind of your outlook. It's one of the reasons that we actually like to do investor days around the 1 to 2 year time frame, because we can maybe level set and shift what that guidance was before. But it's something you have to get really good counsel on, and it involves legal, involves accounting, involves bankers, involves IR. But it's really going to be one of the linchpins that you're going to have to manage over that first year or 2. So guidance is a really important topic, I think, to get some good counsel on.
Thanks. I'd actually like to shift gears a little bit. One of the things that I often see with companies that are looking at a de-SPAC transaction or even a traditional IPO are founders and CEOs who are used to making unilateral decisions about their businesses. And not just about the business strategy, but things like employee compensation issues and titles and bonus plans, changing management when they feel they've woken up in the middle of the night and they need to do that. In working in a public company environment is very different than that. And I've had a number of, advisors to companies say to a founder CEO, is this really what you want to do? Are these the constraints you want to put on yourself? Do you understand what it's like to make decisions like this in a public company environment? Scott, could you maybe give us some thoughts on some of the differences that management has to think about, or founder CEOs have to think about decision-making process and data they have to gather, and sharing some of those decision-making responsibilities?
Sure, Paul. I think you nailed it. As a generality, private companies are far more discretionary in how they manage compensation and benefits. Public companies need to be far more formulaic, and they need to fit within the norms of their peer group. Just to give some insights on a study by Global HR Comp and Benefits firm that did a study of, I think it was about 450 450 public companies, 150 private companies about a year ago. The total compensation package, total direct compensation package between a private company lagged a public company by about 40% at the CEO level, and it's 50% for the for other senior executives. If you look at the different components of that, base compensation, target bonus, and long-term incentives, the base and target bonus were pretty much the same. They vary, by company size a bit, but the real difference was in the long-term incentive plan. And the reason for that is that with long-term incentives, you're trying to drive alignment between the compensation structure and sustainable shareholder returns. And so, with that, we see about 35% of private companies having long-term incentive payment programs versus roughly 97% of public companies do. And so, the good thing before you get out there in the market on the street is, I should say it's a good thing. You need to do this. It's essential. You need to do peer reviews. You need to define the right KPIs and have the right governance in place to make sure you're within the right bands. Otherwise, the street's going to push back on it.
Yeah, there's another wake-up call, too, I think. When, as a private company, you're used to compartmentalizing your audiences, right? I'm going to go talk to my employees now. I'm going to go talk to my customer. And you're going to adapt your message, right to those different constituencies. As a public company, everyone's listening, right? You're on an earnings call. I can't tell you how many times for some of our secularly challenged businesses, we might want to talk about margin expansion and reduction in headcount and restructuring, because that's going to really appeal to my investor audience. That's really the focus of that call. But we got employees on the phone. We got customers on the phone, right? We've got the press on the phone, and we've got to be very thoughtful about the way that we communicate the things that we do in these public forums. And so that's a huge wake-up call, I think, for companies. I think especially a lot of CEOs are used to communicating to their employees in a very open fashion. You have to be a lot more careful with that communication now. Any memo that is sent broadly, I usually tell our clients, you should expect that will probably end up public, whether it's through a chat board, whether it's through a leak to a press, whatever it might be. And so a lot of those things can kind of be wake-up calls in terms of how you compartmentalize audience and communicate, too. You have to be much more thoughtful as a public company.
Chris, that's something that I've seen as an issue, because oftentimes, CEOs are used to having company-wide meetings, whether they're in person or in video calls, and they want to share everything with their employees. It's a form of motivation. It's making them feel part of the team. But it does raise concerns about who ultimately is sharing that information. If you've got a team of 10 people and they're all sworn to confidentiality, you might be okay doing that. When you start having hundreds or thousands of employees, you really have to assume, as you say, you're talking to the public. You're not just talking to your employee group. So I know we're coming up near the end of the hour. So it might make sense to among the group, just see if each of you has a few last thoughts or you'd like to share or respond to some of the questions that people have posted that we might not have gotten to. I think we got to a number of them. But John, you want to take a minute or two, and then yeah. Scott and Chris, we can wrap up?
Yeah, just looking at some of the questions, and I really appreciate them. First is, a SPAC sponsor, has a certain experience in a business path that got them to, managing a SPAC. And that's the management team to look for, whether that SPAC team, typically the SPAC team is a board which is majority independent. Another thing that privately held companies need to think about is they need a majority independent board. And there's a couple operating people in the SPAC. Usually the board is helpful. They might have some deal flow. They might help with diligence and analysis of that privately held company. But it's typically a CEO, CFO, maybe a VP that's helping them manage the SPAC, usually a small deal team. In our case, we have a pretty big deal team because it's sponsored by 2 investment banks. And you should be looking for that team to have something that you want as a public company, whether it's contacts, whether it's expertise, again, using the healthcare, maybe it's someone in, I'll use an example. There's a SPAC, I don't know the guys, but Keith Meister, who's a titan of the hedge fund industry and corporate governance, and Eli Kasdan, who's one of the most sophisticated healthcare investors, in the world. They combine together to do a SPAC, and so they cover the boardroom, they cover management, they cover relationships all over the healthcare universe. So merging with that SPAC, was important to that private company, to that biotech company, because they just they opened up one of the most amazing Rolodexes that they possibly could to help them not only with capital but how to grow and foster that board. They brought in people from, MD Anderson or whatever it may be. That's something to look for in a SPAC. Today we have 420 SPACs out there, and it is a greed product. So there are people that they just want to get a deal done. They might not be able to help you. That's not someone that's, opening up doors and carrying your business going forward. I would say, there are a lot of things here, whether it's, the disclosures we talked about as a public company and giving guidance. It's something that you can do with the SPAC. You can't really as an IPO, and it's something to be very careful about working with your advisors. I think, there's other things. There's expenses here. You've got D&O insurance has skyrocketed. You need it as a public company. We found D&O insurance to be 4 times what it was, 24 months ago. That's an expense you should look at. And as everyone said here, you're a public company. You need to figure out how you can disclose things. You might not be able to have your 1,000 employees on the phone to understand everything. Someone might trade on inside information. Here's another thing that you need to look at. All in, I am a bull in SPACs, depending on the situation and depending on the opportunity. But I have seen for the past 15 years, I've seen companies that like the money, like to be public, and then when they were public, kind of walked away from, operating like a public company, and they got in the penalty box and the stock was at 2, or some of them went to 0. And why didn't it work? They were ill prepared. They were not ready, for college, and they jumped into, a graduate class already. So this is an area of finance that's unique. It can be fun, but it can also be very dangerous. And there's a lot of liability here. There's a lot of class action lawsuits, and the dust will settle here. We need to, really do our diligence on who we're merging with, or why are we going public? What is the reason? Why are we doing this SPAC versus an IPO? If there's a reason, the time, the speed, it's fantastic. If not, it could be very, catastrophic.
Yeah, I think that's good advice. It all comes down to preparation and understanding what you're getting yourself into. Scott?
I'm not sure what more there is to say after that, Paul and John. You're spot on. It's preparation. It's the financial preparation. It's the governance. It's the internal controls. It's the compensation and benefits. It's the investor relations. All those things need to be in place. And although this is an accelerated, sometimes accelerated pathway to public markets, that shouldn't be looked at as a free pass to ignore these things. Organizations need to understand why they want to be in public markets, and if it strategically is a good decision and it's a good timeline for them. If you believe it is a good place for you to be and you're looking for liquidity to grow operations, grow commercial, invest in R&D, it's a great way to go. But don't short sight the amount of preparation that's required. And John, I think you hit on it. Look for the sponsor groups that can really bring something to the table other than cash. Where do you have the alignment with the sponsor group from a channel standpoint that are going to accelerate your commercialization or open up other doors for you? And I'd say finally, not self-serving, seek the advice of professionals. I mean, you have a responsibility to grow your business and continue to manage operations. It takes a lot of time and it takes a lot of effort to manage all the different needs that you have to, from a regulatory standpoint, SEC submissions and comment periods, and navigating between IR firms, lawyers, auditors, bankers, and so forth. And so you seek professional help on it.
Thanks. Chris?
I'm glad Scott hit on some of the pros. I feel like we focused a lot of our attention on some of the cons, so that was great. I'll hit two of the questions I saw in the chat because I think they're relevant. So, when's the right time to engage an IR firm? I think there's two appropriate times. A lot of times it's such a whirlwind, and the banker's going to help you kind of get the deal in place. A lot of times we end up getting placed a day or two after the announcement of the deal. I would suggest if you have the ability, though, to get an IR firm in a month before you do a deal, you're headed down the SPAC capability. I just think an IR firm brings a different perspective, right? Again, banker, sponsor, management focused on deal have somebody in the room that says, hey, 2 years from now, if we use that metric, I don't think it's going to look good for us, and I'm not sure we should use it. So get a long-term thinker in the room if you can, probably between 2 and 4 weeks before you actually do a deal. And then there was another question on ESG. I think this is an important one. It's gotten more and more interlinked into what I do and what we do here. I still think ESG is much more focused on being a good corporate citizen for your brand and for your employees than it is on the investor side. That said, there are significant assets, coming in on the ESG side. It was pretty small a few years ago, but through COVID and through the pandemic, we've seen some real interesting increases in those funds. The key for those is that there is a significant number of ETFs and more quantitative funds. If you don't have an ESG sustainability report on your website, you will not get into those funds. And those funds are generally operating some pretty large, diversified holdings. And so you need at least, I think, and it's probably not one of the first things that you're going to focus on as a SPAC, but within your first 6 months, we will usually build at least some basic sustainability reports to make sure our clients can get into, some of those different those different ETFs, and get that kind of trading volume that can help support this. So I wanted to hit those two. Those were two that I saw towards the end of the Q&A. So thank you again for everybody's time. I'll kick it back to you, Paul.
So, and I just try to respond quickly before we wrap up to one of the other questions that we got, which is the role or responsibility of the general counsel or chief legal officer as part of the management team, and how that interacts with some of the planning for the CFO and the rest of the group for life as a public company. In my experience, the CFO has the biggest burden on being a public company and making that transition, but the general counsel oftentimes has the most frustrating role, because they are really the center of trying to educate the rest of the team about their responsibilities, manage all of the new public company policies and educate people about things like insider trading, manage the SEC reporting timeline, educate the board of directors about their roles and responsibilities from a governance perspective, as well as the audit committee, the comp committee, the nominating and governance committee, and so on. Unlike companies that have planned for an IPO, that have probably put together a board sometime before the actual IPO is completed and put in place a lot of the governance provisions, and had some experience working through that and working as an audit committee and working as a board. Oftentimes in the de-SPAC context, the board is made up of a couple of executives from the target company, 1 or 2 people from the SPAC, and then oftentimes 3, 4, 5 newly selected independent board members who may have great experience as public company directors, but have not worked together in this particular company. And so there's a transition period that I think the GC oftentimes has to help manage from a process view to get the board and those committees and the rest of the management team functioning in a way that actually complies with all the policies that the company has put in place and the processes the company has put in place in preparation for the de-SPAC transaction. We've run a little bit over. I really appreciate everybody's time and interest in all the questions that we got. There are some resources available on SPACs and related materials on the bottom right side of your page, and we hope everybody takes advantage of those. And I'm sure I will, and I'm sure the rest of the panelists, if there are follow-up questions that folks have and they want to email us about them at some point later, we're happy to help try to address those. We did try to get through as many of the questions as we could this afternoon. And thank you all again for joining us.
Thanks, everyone.